Today we're going to discuss a strategy called pairs trading. It's been said pairs trading is the simplest possible example of employing a market-neutral strategy. Basically today we're going to learn how to profit no matter what the market's doing. Whether it's going up or down isn't going to matter for a pairs trader. For a pairs trader, the only thing that matters is the relative value of shares. But first let's look at what instruments we're going to trade. The most common instruments for implementing pairs trades are single stock futures, contracts for difference, index futures, options, although they're probably the least common due to the high costs. The reason that you look at using geared contracts is because in a pairs trade you need to short sell. Conventional wisdom is to buy low and sell high, but you could also sell high and then buy back in low. Going long simply means you think that the share is going to go up in price. Going short means you expect the price of the underlying to fall. So what exactly is pairs trading? It was first used by Morgan Stanley as a highly effective trading strategy on their prop trading desks in the 1980s. Pairs trading is loosely defined as trading one financial instrument against a second financial instrument, or possibly many. It involves simultaneously buying one share long and selling another share short against it with equal cash exposures in anticipation of profiting from the two shares' prices converging. It is a non-directional strategy that attempts to make profits under any market conditions. So how does the strategy work? First, you need to identify shares which have significantly over or underperformed relative to other shares in the same sector for no real identifiable reason. You then need to determine whether this move away from the normal relationship between the two shares is the result of a fundamental shift in the relationship. You then need to ascertain if and at what level we can expect the divergence between the two share prices to reverse and converge back towards the pair's mean, back towards their normal relationship. You can then enter the trade by buying the underperforming share and short selling the outperforming share and profiting from the convergence of the two share prices. As a pairs trader, our objective is to buy the shares we think are cheap at the same time as selling shares that we think are expensive in the same or similar sectors. We want to do these trades in the correct ratios with respect to each other and with the same rand exposures. For example, Anglo American has significantly outperformed BHP Billiton over the last 6 months, possibly a bit too much. So we would buy BHP Billiton at 230 Rand and sell Anglo American at 320 Rand. This would be the ratio of about 1.39. i.e. for every 100 Anglo-American shares sold, we would buy roughly 139 Billiton in order for the trade to be market neutral. In both legs of the pair, there's an equal cash exposure of 32,000. So how do you make money? Basically, profit will be made when the two share prices converge. The following situations will create a profitable trade. The ideal situation is if Anglo falls, which we're short, and Billiton rises. That would be the perfect situation. But you'll still make money, even if both Anglo and Billiton rise, but as long as BHP Billiton rises slightly more than Anglo-American. Remember, your analysis has shown that Anglo-American should be the slightly weaker share of the two. On the other hand, even if the general market level falls, and Anglo-American falls as well as BHP Billiton, as long as Billiton falls slightly less than Anglo-American, you'll still make profit. Because pairs trading creates a market-neutral position, the overall market direction or direction of either Anglo or Billiton doesn't actually matter. The only thing that matters is the relative performance of Anglo versus Billiton. Pairs trades do not require you to forecast the overall direction of the market or even the direction of the specific shares in the pairs trade in order to make money. In other words, you don't have to care where the market is going, unlike in normal directional trading. The benefit of being market neutral is therefore the ability to remove the market risk or systemic risk associated with trading. So what kind of pairs are tradable? Traditionally, shares should be historically correlated with each other and operate in the same or similar economic sectors. For example, ABSA versus Standard Bank, or Implats versus Amplats. There are, however, some shares that operate in different sectors, but do have a statistical relationship which can be paired. For example, Anglo-American versus MTN has in the past had a strong statistical relationship. It's best to avoid this type of pair unless we have fundamental reasoning behind the trade. I hope you've learned a bit about pairs trading. If you want to start trading, simply give us a call on 011 451 0206. or you can email me, Gary, at absolutealpha.co.za. And remember, as a Fleet Street subscriber, you will get your first trade free.